Okay. Now, all right, welcome to Spring Clean Your Finances. I'm Alpha from Money Made Simple, and tonight we got the main topic, which I can get my screen to move along. Here we go. So we're going to talk about spending, and specifically how to cut the fat, as I call it, from spending without going through the laborious process of budgeting. It's not a fun exercise, and it's difficult to keep to. And like with anything like exercise, if you don't start to see improvements, you start to lose confidence and momentum, and then it all falls apart. So we're not going to go through budgeting, but we will look at how to identify discretionary, non-discretionary, etc. spending, and how to streamline that. And look at, there's a technique I use called the money pie, which I'll go into. So how to save more effectively and make it more structured and planned and organized and automated, and also specifically how to save for kids. This is something that as every parent, we want to make sure that we've got money for our kids, whether it's education or helping them. Most of these things come as lump sums, and it's difficult to try and scramble money together. And you don't want to be taking out loans, that kind of thing, nor do you want to lump your kids with a big loan just as they're starting their professional lives either. And we will go through superannuation and some simple ways to boost that and to make sure that you're optimizing your superannuation as much as possible. And then at the end, we'll go through Q&A, and you can ask me some questions that you might have, and yeah, we'll take it from there. So when it comes to spending, cutting the fat it's actually easier than you think it might be. I actually went through this process myself, and I go through it pretty much every year as well. But what started it off was when I was pregnant with my daughter, and I was a contractor, so I wasn't going to get maternity leave. I also wasn't going to get any government maternity support either. And I didn't know how long it would be until I would work again. So I had to try and make sure I had stretch for an indefinite period. So I went through the process of literally going through my credit card and my bank statements line by line, sort of checking what was there, what could I do without, and what could I reduce, and what could I absolutely not. So that's where I have to talk about the concept of discretionary versus non-discretionary. So non-discretionary are things that you need to survive. So you need somewhere to live, so you need to pay either rent or a mortgage. That's non-negotiable. If you are renting, it could be possible to try and sort of the lifestyle or the abode that you're living in to make it cheaper. In this day and age, that is probably easier said than done, considering the housing market is pretty tight. So while it is non-discretionary, there may be opportunities to flex in that space. And I'm not going to get into mortgage repayments because that's a whole nother topic. Then there's food. You've got to eat. There are ways to try look at the brands that you buy, and some of the things that you eat. You can possibly sort of meals, or buy takeaway just to sort of stretch the dollar a bit further. Then there's fuel. Unfortunately, that's more or less non-discretionary, and at the moment the prices are pretty high. But maybe ride your bike if you can a little bit more, especially if you take your child to school and it's close by. Maybe walk, catch the bus, or a bicycle. That's another option, just to try and limit perhaps the amount of driving and the petrol that's being used. Mobile phone is non-discretionary. There's a few things in there, and the definitions will probably differ from person to person. I know I went through this process with a client a couple of years ago and was looking at their streaming services, and they had about 5. I didn't even realize it, and they were about non-discretionary. There was no way they were going to go on any of that. So whereas for me is, that sort of thing is not necessarily that important, but it depends. So you do have to apply a little bit of discernment in that process. But discretionary would be, and again, this will depend on the individual, but clothes to a certain extent. Obviously, you don't want to walk around naked, but how much and how expensive the clothes are and shoes, and it also depends on whether or not you've got children, and that toys. You can borrow things or buy secondhand a bit more. I know my daughter needs a new bicycle. She's growing out of the one she's got. So for Christmas, she's getting a new bike, but it's a $40 fixer-up I found on Facebook Marketplace. And I've got a friend who's a really great bicycle mechanic. So he's going to do it up and make it as good as new. So it's that sort of thing, just to try and be a bit more thrifty. So that's sort of looking through, and again, looking through your credit card statements, because quite a few things in there that we forget about. I know I was paying for and getting annual bills for a just like a picture service, which I must have. And although it's not a huge amount, it's still something. And there were other signed up for some apps for my daughter to keep her entertained. We hadn't used them for ages. I was being charged. One was $8 a month, another was $13 a month, and this has been going on for about a year. So they can add up. So it's just cutting out little bits and pieces like that, and then reviewing things like your insurances as well. I went through that exercise myself just recently and saved over $700 in a year. So you'd be surprised what can be in there when you actually look. And that's what I'm saying. It's not about budgeting per se, but it's looking at what you're paying for and what you really need, and needs versus want, which is your discretionary versus non-discretionary versus discretionary. Then there's the issue of, are you spending too much or are you earning too little? And I know that's oversimplifying the concept of spending and earning, but sometimes it's the being behind or having a negative spend to income ratio is because you're spending too much, or it could be that the lifestyle that you've got, even though you've tried to cut things right back to the bare bones, you're just not earning enough income to try and cover it all. And that's where that concept of versatile, even though I'm not a huge fan of that terminology, can come into play, or perhaps looking to upskill or change. Perhaps, the market, you've sort of gotten yourself stuck in a role, and this has happened to me. I was sort of stuck in a role, and whenever you did annual salary reviews, you got incrementally increased based on your current salary. But if you jumped to another company, you probably jumped 10, 15, and that became sort of your base salary or baseline as well. So like that, becomes creative and thinking outside the box and being brave. Because some of this does take part something else. I'm just going to go clean the bathroom because I prefer to clean the bathroom before I look at this stuff. You know what? The bathroom can wait. I need to do this. I do it once a year. It's done. I implement it, and I don't have to worry about it again. And the bathroom will still be there, and you'll still need to clean it anyway. So that's where the spending side comes in. You look at it, and it's you just need to set some time aside at the end. So I'll move on from spending onto saving, and this is money pie. And yes, I do want my spreadsheets and graphs. Not that I expect everybody to be so inclined. I do have one friend who cringes every time I mention the word spreadsheet, but then she's always wanting to use my templates anyway, so they do come in handy. Now this pie is just for example purposes. This isn't necessarily how each individual person's money pie will look, but it's more indicative to show you that the largest chunk of that pie is going to be the main things that you spend on. So whether it's your bills, debt that you're paying, or your rent, things like that. So it's most of the non-discretionary things with a little bit of discretionary built in as well. So that's huge. That's quite a large chunk, and you need to try and make sure that that doesn't take up 100%. You need to be able to carve some of that back out to make. So saving for emergencies. This is quite important, especially in this day and age. There's so many things that are happening that are unprecedented, and it's difficult to plan for. And I myself have utilized the emergency funds last year when my husband got made redundant quite out of the blue, and it ended up taking him 8 months to find another job. So even though I have to have minimum 3 months salary, when you need to, you can pull the purse strings in and you can make that 3 months last longer. And thankfully, we still had my income, so that helped. We weren't completely out of income, which was very lucky. But that emergency fund came in really handy. So that's an important one to make sure that you do actually put, and I would say about 15% aside, or what it equates to for 3 months salary, household salary. Then fun. You've got to have some fun and set some money aside for that fun, because life is boring without fun. Just recently, I went to Uluru, which was a bit of a bucket list item. I had wanted to go there for many, many years and finally made it there. And I'd been saving and putting money away. But by the time we went, and I had to, we got there and there was an opportunity to go on a helicopter ride. And I was like, you know what? I put money aside for this, so I'm not going to feel guilty and penny pinch to go no. So my 6-year-old daughter got to go on her first helicopter ride as well, because of course I couldn't go without it. So that enabled us to have a lot of fun and not have to come back to credit card debt at the end of a holiday, which is the last thing you want. You're still on a bit of a high, a little bit of a down because you're back to reality, but the credit card bill will just make you come back down with a bump, and you really don't want that. So fun is very important. Then for those who have children, especially younger children, it is worth to put money aside to save for your kids, whether it be for tertiary education, even if you want to send them to a private secondary school, help sort of soften the blow of the fees when they come in. I'll talk about that in the next slide. There's tax effective ways to save for your kids, because coming from a tax background, and I know, Nicole, you'll appreciate this as well, because the first thing that usually comes into our minds is, oh my goodness, the tax issues that will go with this. So there are opportunities in that space. Then investment. So even though, and that 10% will differ depending on individual circumstances, but while the main focus is on paying down debt, paying bills, and putting some money into savings and emergencies, it's also a good idea to start having a little bit of money put aside. You can do micro investing even. There's these apps now. I joined, they were called Acorns. They've since rebranded to themselves to be called Raise, which somehow I don't connect with as much, but I joined them when they first started about 4 years ago, and it literally is roundups. So every time I spend something, I've connected my credit card and bank account to them. And every time I make a purchase, they round it up to the nearest dollar, store that away, and then once it gets to a certain amount of money, they invest. And just purely on roundups, over the last 4 years, I'm up to just over $4,000. So that's money that I've got, which I haven't done anything really to kind of to get there, and it's just plugging away. So even if you only do something like that, you'll end up with something rather than nothing over time. So there are opportunities, and it makes you feel really good. You're like, oh, I'm an investor. This is great. I mean, anybody who has superannuation is an investor, but it's a little more invisible. Whereas this is something that you can actually do something about yourself. And that confidence in your money life as well. So I'll go on to the kids saving. Now, you may or may not be aware of these. They're called investment bonds or growth bonds. It used to be an insurance, like a life insurance product people would use before the current version of life insurance came into being. People would sort of self-insure, and they literally put their own money away over years in the event of their death, that their loved ones would have a chunk of money to help pay for bills and death and funerals and all of that kind of thing. The advantage of them is their tax effectiveness. This obviously applies if your effective tax rate. So if the tax rate that you're paying on your income that you earn is more than 30%, this will be a benefit. If it isn't, then you really need to probably just put money aside, but you've got to be disciplined. The thing I like about the investment bonds is they're not as inaccessible as superannuation, but they are kind of put aside, and it's a bit more difficult to touch, and if you touch it. So there's not that temptation to just dig into it, because if you're a bit short this month on expenses, or on your mortgage payments and so forth, and it's there for a specific purpose. You can also then spend money. You can use that money on whatever you like. There are funds out there to help you save for children's tertiary or further education, but you've got to spend it on that. So it is a lot more limited in that regard. So I personally like having the stability gives me that. Like I have mentioned, there are a couple of rules there, and you can see a financial planner to help you set it up. You can set it up on your own, but if you're unsure and you'd like to go for a financial planner, then definitely go down that path. The product statements that go with these are usually quite long. I am a bit of a geek and I have read them, but yeah, some of it's just terminology. So the other thing you can also do with these is they have a child advancement policy. So while the actual bond is in your name, you can have it vested to your child at a certain age, minimum of 16 years of age, and then it's up to you. At the moment, I've set it for my daughter when she's 21, because I don't really feel like she'd be mature enough to do anything with it. I can still use the money prior to that. So after you've kept all the other rules, you can actually start to withdraw money from it without the tax penalty. For education, you can help them buy their first car. I wouldn't completely buy it for them, otherwise they might not understand the value of money quite so much. So that then becomes another problem to deal with. Yeah, so there's a lot of layers to that, but it is an option to explore for saving for kids. Superannuation. So this is I get asked a lot. There's a lot of concern from people I speak to and from clients about their retirement and not understanding superannuation. It's confusing. What are the current rules? What can they contribute? What can't they contribute? Is it really their money? They feel like it's just a bit of a minefield. Well, the answer to is it really your money? Yes, it is. It is actually money that's getting paid, and it's usually a lot of employers package superannuation into the remuneration package these days. The superannuation has just recently increased to 10% as a minimum contribution. A lot of there are companies, especially government departments, that will pay in excess of that, which is great. And there are companies, usually big corporates, who will make extra contributions, and if staff, they'll match those. So it's worth finding out from your HR department if that's available. There are some limits, which I mentioned in that first point there. So at the moment, and this limit is going to increase in the next, I think, year, at $25,000. So what that means is, and that one of the advantages of superannuation is that the tax percent, which is generally a lot lower than most people's marginal tax rate, and then their effective rate that they're paying. So that there's an advantage in that regard, which is why you hear these stories of people trying to funnel as much as they can into, especially for income earners who are salaried, and how much they can contribute. So $25 is the limit of the contributions, the pre-tax contributions that can be made, as well. Before that, 15% is no longer applied, and you actually start to revert back to your highest marginal tax rate on your super balance. Insurances are have developed over time and have become part of the super kind of structure. Recently, they changed the rules to say that you actually had to choose whether or not you wanted to have insurance in your super. Previously, it just was automatically added to you just got the basic insurance without having to opt in. Now they call it opting in, where you have to make the choice, active choice, to have super insurance in your superannuation fund, rather than it just automatically being there and you're not being aware of it. There are advantages and disadvantages to having it inside your super, and this is one area where I highly recommend you actually do talk to a professional and a risk specialist when it comes to these sorts of insurances, because like I said, individual circumstances really do need to be considered, the type of coverage, the type of insurance as well. So you can have typically life insurance, total and permanent total and permanent disability, which is a TPD. There's also what they call a buyback option for that. There's trauma insurance. Again, there's a buyback option for that too. There's income protection, which is tax deductible. The others are not. So there's a whole lot of stuff, and there's insurances inside super. There's usually an age limit of 70 years old for those, whereas outside of super, quite often you can have them up to the age of 99. The type of anyway, I don't want to scare you away from it, but it is worthwhile talking to a financial professional in that who specialises in risk and insurances, because that is something I think is quite important. I personally have my personal insurances outside of super. There's two layers of things that hoops you need to jump through if you actually need to claim on it, and I didn't want those two hoops. And I also didn't want the insurance premium to reduce my superannuation balance, because it does actually, you still are for it, and so it will actually reduce your super balance. I want to know that the 25,000 that I put into super is what's actually going in, not that less the insurance premium. So that's something else just to consider as well. The other thing is administration fees. I did a video recently that looks at the calculators that the Money Smart website, which is a government-run website, has, and it shows the difference comparing even 0.5% makes over the life of your super balance. It's pretty hefty. Like it's tens of thousands of dollars extra. So you really want to try and find a super fund with low administration fees and also low investment fees as well. Sometimes that will depend on the investment portfolio that you've chosen in the super fund. So it's worthwhile doing a bit of research. And if you don't want to read through the documents that they have, just call them up. You're paying fees. You have the right to actually talk to somebody and say, look, can you walk me through this, because I don't understand it. I don't know where to find the information. It's confusing, because let's face it, the documentation is just immense when it comes to all this sort of thing. And it's things, and you want the answers. So actually call your super funds, and don't be afraid to hold them to account and say, look, this super fund over here just got nominated Australian Super Fund of the Year. Why are you not? And maybe, I mean, the person on the phone obviously isn't really responsible for that, but they are representing that fund. So feel free to ask some pretty direct questions. So you want low administration fees, low investment fees, and then you want to also have a look at investment performance as well. Obviously, past performance won't indicate or be a guarantee of future performance, but there are some super funds out there that consistently perform quite well, that have low administration fees and low investment fees. So that's the balance that you want to be able to get. So even if you're curious, just Google or put into a web search browser or compare best Australian superannuation funds and see what comes up. Also be aware though that some of those comparison sites are actually being paid. So they're not necessarily completely impartial. So just make sure that you're aware of that as well. And then the risk profile. So a lot of the super funds nowadays, in the Money Made Simple course, I actually go through a comparison of some funds and do like a live example. And the risk profiles of that depend on the type of investor you've chosen in your super fund. Some super funds now actually let you invest in direct shares. So if you want to dabble in shares, you can actually do it with your super funds. I would caution that though, to make sure that you know what you're doing. You can also buy your index funds, all that kind of thing inside your super fund. Like I said, if you're comfortable that you know what you're doing, or you've had a look at your sort of risk profile, you're somebody that's okay. Like if you see your super balance tumble, because you've got about 10, 15 years left of working life ahead of you and you're okay, you're like, okay, well, maybe I can deal with a little bit of risk here, because now usually they say between 7 and 10 years, quite often it will take the market to recover. So have a look at that. Again, you might want to actually talk to a financial planner or a finance professional in that regard as well. So superannuation, there is quite a bit to it. So here, but if you do have questions, please ask. You can email them to me as well. So we'll get to in a moment. So if you want to know a little bit more about spending, I actually have a free guide on my website which actually takes